what I do want to talk about and want you to be aware of is that it does affect your buying power. It does affect how much home you can afford, how much home you can qualify, and those all important monthly payments. Let's be honest, most of us have to budget. Most of us have to pay our bills every month. So when that interest rate affects that monthly budget, even if you still qualify for just as much house, every $1,000 that you borrow is going to cost you more money. So interest rate. It's been all over the news, and it certainly affects your home buying ability. The Fed just increased interest rate another 1/4 point 4 days ago as of the viewing or taping of this video, and that's going to have some effect on interest rates when you go to buy a house. The great thing about it is because they've been announcing interest rates, a lot of the mortgages have already priced those interest rates into their quotes that you've been getting. So it doesn't mean it will necessarily affect you today. It doesn't mean your rate would necessarily go up 1/4% today because they raised your rate. However, they are planning and anticipate that they will continue to increase rates all throughout this year. And as they do that, it's going to cost banks more money to borrow from one another, and rates will tick up in accordance with that as it goes along. So just be aware of it. Interest rates probably are going to go up. They're probably not going to go crazy. It's probably not going to kill the housing market because, for one, we've been at these crazy low rates. 15 years ago when I bought my house, I paid over 6% for a mortgage, and we've been down in the 3s and 4s. So even if it goes to 4.5, that's still 16 years ago. Nobody had ever heard of a 4.5 in the last 30 or 40 years. So it's an amazing interest rate. So don't let that scare you too much. But what I do want to talk about and want you to be aware of is that it does affect your buying power. It does affect how much home you can afford, how much home you can qualify, and those all important monthly payments. Let's be honest, most of us have to budget. Most of us have to pay our bills every month. So when that interest rate affects that monthly budget, even if you still qualify for just as much house, every $1,000 that you borrow is going to cost you more money. You have to be aware of that. So you may qualify for one amount, but if the monthly budget that you're comfortable paying is lower than that amount, you may not want to buy what you qualify for. And that's where you got to be really aware of how these interest rates can affect you. So I use calculator.net quite often just to take a look at rates, play around with what the different effects on rates and pricings do, and that kind of stuff. So I just wanted to run a couple quick calculations, show you what you're looking at, and that kind of stuff. Here in Shelby County, Tennessee, the average price has been right around $300,000 the last few months for the homes that have closed. So let's just take a look at that. Now, this is a 20% down conventional mortgage. Of course, it can be adjusted any way in the world, with different down payments, different types of loans. I am not counting any PMI. I am not counting any interest or tax escrows because I want to keep it super simple. So this is only what we would call your principal and interest on your loan, which would be your base payment that you would pay that is affected by the amount that you borrow and by the mortgage rate, okay? Because those are the two things that really determine your amount of your monthly payment. So if you purchase a $300,000 house and you put 20% down, which on $300,000 is $60,000, you're borrowing $240,000. At 3.5% interest, and again, per calculator.net, so could be a little bit of variance there, they show that your monthly payment for principal and interest only would be $1,077. So let's see what happens if we just adjust that amount to 1%. Let's say we go from a 3.5% mortgage to a 4.5% mortgage. We were at $1,077 a month. When we go to 4.5, we go to $1,216 a month. So on that $300,000 house, you borrowed $240 on a 30-year loan. There is about $140 difference going from a 3.5% loan to a 4.5%. So what does that mean, Donnie? What does that mean in the amount of homes that I can qualify for? Well, it means that for that 140, how many additional $1,000 could you borrow to keep your payment to be the same? In general, on a 3.5% loan, it increases your payment about $3 for every $1,000 that you borrow. On a 4.5% loan, it increases that payment $4 to $5 for every $1,000 that you borrow. So that $140 would be on a lower rate, might be an additional $45,000 that you could borrow. whereas on a higher rate that affects it by $4 or $5 might be an additional $25,000 that you can borrow, just roundabout numbers. So the important thing to consider there is you may have to adjust your budget down if your interest rate were to creep up, or you might need to make a decision that, hey, I'm going to go in really strong, get the house bought that I need now so that I can use the payment to keep the payment in the same place, and I can use the dollars that I qualify at the lower interest rate to lock in that payment for 30 years before rates go up any further. So this is one of the things where people always ask us, is this a good time to buy houses? Homes are expensive, interest rates are going up, oh my goodness. Well, none of us have a crystal ball. What you do know, and what we all know, is what you lock in today is what you've got locked in for the next 30 years if you get a 30-year loan. So if you find the house that you love today, even if you have to bid more than list price or go a little stronger than you wanted to, but you lock in a super low rate, that payment is locked in for 30 years and you don't have to worry about it. Interest rates go up, it doesn't affect you, it doesn't change you. So if it works for your family today, I normally tell my buyers and sellers that's the way to go, because none of us have a crystal ball in the future. Do you know how many people I have seen in the last 2 or 3 years that said, hey, I'm not going to buy a home, and then maybe they said this 3 years ago because prices are too high and I think they're going to come back down. Well, guess what? They could have spent $60,000 on rent in the last 3 years. They never get any of that back. They did not build any equity with any of that. They did not get any tax write-offs with any of that. In addition to that, they're now probably paying $100,000 more for the house. So those people 3 years ago who thought, oh, prices are way too high, I'm going to wait, they've lost, in that scenario, $160,000 by waiting 3 years, and there's no end in sight. Plus now interest rates are going up, whereas 3 years ago they could have locked in maybe a 3.875 or even a 3% even in some cases, whatever the case might be, and they would have that rate locked in and they'd already had 3 years worth of equity built up. So I hope that information helps you out. Just make sure you're aware of how interest rates change. Don't be scared to ask your lenders that, hey, how is this going to affect me? What interest rates I lock in, how much I borrow, because ultimately that monthly payment is what it's going to make you or break you, because that's what you got to be able to pay month in and month out every month. Thanks for the video. If you have any questions, put them in the comments and we'll always get back to you. As always, you can reach out to me directly. Find my details in the description. We'll see you next week.